You did everything they told you to do. Go to school, get the degree, find a stable job, work hard, get promoted, make six figures, be responsible. And somehow, you still feel behind. That's not you being lazy. That's not you being bad with money. That's not because you buy too much coffee. It's because nobody showed you the brutal math. Here's the truth. The middle class is being taxed into exhaustion because it relies almost entirely on the one type of income the system can grab first, easiest, and most aggressively: your W-2 paycheck. Before your money even touches your checking account, it gets shaved. Federal income tax, payroll tax, state tax if you live in one, maybe local tax, then sales tax when you spend it, then property tax if you buy a house. And people still wonder why a lot of high earners feel broke. That's the invisible prison. It doesn't feel like prison because the bars are polished. They call it a career. They call it benefits. They call it security. They call it success. But if the system requires you to trade your time for money, then taxes that money heavily, then inflates away the rest while assets rise faster than your savings, you are not climbing. You are running on a treadmill that somebody else controls. And the most dangerous part? You can look successful while getting slowly financially strangled. Nice apartment, decent car, a raise last year, vacation photos online, but underneath, stress. No margin, no real ownership, no freedom. So today, I'm pulling back the curtain. I'm going to show you why the W-2 path becomes a trap, why the finish line keeps moving, and why the tax code quietly rewards the people who own things while punishing the people who work hardest. And more importantly, I'm going to show you how to escape without blowing up your life. Because this channel is not anti-job. It's anti-staying trapped in a job-only strategy. So if you're a hard-working employee, listen carefully. Don't let this happen. Let's simplify the entire game. There are basically two ways to make money. One, you sell your time. Two, you own assets. The middle class is told to master option one. The wealthy obsess over option two. That is the whole divide. A W-2 worker makes money by showing up. An investor makes money because something is owned. Stocks, real estate, a business, intellectual property, equity. One person gets paid for labor, the other gets paid for leverage. And the tax code knows the difference. If you're a W-2 employee, the government usually takes its cut automatically. You don't even get the psychological benefit of holding the full amount first. That matters, because behaviorally, what you never touch, you stop questioning. The money disappears before it feels like yours. The IRS literally says employers withhold income tax from employee paychecks and pay it in the employee's name. That's why W-2 income feels so normal to lose. It's removed before you emotionally register the loss. Now, compare that to asset income. Long-term capital gains, qualified dividends, different rates, much lower in many cases. Why? Because the system wants capital formation. It wants investment. It rewards ownership. And who helped shape the rules? People who own assets. So when I say he's robbing you, I'm not saying there's a cartoon villain in a top hat sneaking into your apartment. I'm saying the rules are tilted. Quietly, legally, systemically. Not with a gun, with a tax code. Now let's talk about raises. A lot of people think a raise will save them. And look, I'm not anti-raise. Take the raise. But understand what actually happens. You move up, you earn more, you pay a higher rate on the next slice of income, your lifestyle expands, your work stress increases, your free time disappears. Congratulations, you may have just upgraded your prison cell. That's what golden handcuffs are. More salary, less freedom, more expectations, more dependency on the next paycheck. You're working 50 hours a week, sometimes 60. Your boss owns your calendar. Your employer controls your income stream. And the government skims off the top before you can deploy the money into anything that might actually free you. So yes, technically you got richer, but functionally, you got more expensive to maintain. That's the trap. Because the W-2 path trains you to think like this: if I can just make more money, I'll be fine. But the investor thinks differently. How do I convert active income into assets that produce lighter taxed or tax-advantaged income later? That's a completely different operating system. And if you never make that switch, you stay dependent on labor forever. That's why so many high earners look wealthy but aren't free, because income is not the same as ownership, and ownership is what the tax code keeps nudging you toward. Let's do the side-by-side. No fluff, no motivational quotes, just math. Two people. Person A makes $150,000 from a W-2 job. Person B makes $150,000 from long-term capital gains and qualified dividends. Same headline income, very different reality. Person A, $150,000 W-2 employee. Single filer, standard deduction $15,750, taxable income $134,250. Now, the federal income tax stack looks like this. 10% on the first $11,925 equals $1,192.50. 12% on the next $36,550 equals $4,386. 22% on the next $54,875 equals $12,072.50. 24% on the next $30,900 equals $7,416. Federal income tax total, $25,067. Now add payroll taxes. Social Security, 6.2% of $150,000 equals $9,300. Medicare, 1.45% of $150,000 equals $2,175. Payroll tax total, $11,475. Total federal tax drag, $36,542. That leaves Person A with about $113,458. And that is before state tax, before local tax, before sales tax, before property tax, before inflation quietly body slams the rest. Person B, $150,000 long-term capital gains and qualified dividends. Same single filer, same standard deduction, taxable income after deduction, $134,250. Now, here's where it gets wild. For single filers in 2025, qualified dividends and long-term capital gains are taxed at 0% up to $48,350, then 15% up to $533,400. So Person B pays 0% on the first $48,350 equals $0, 15% on the remaining $86,900 equals $12,885. No Social Security tax, no Medicare payroll tax on that investment income. Total federal tax, $12,885. Take home about $137,115. Same $150,000, but person B keeps about $23,657 more than person A. That's almost $2,000 extra every month. Every month. That is the brutal math. And this is why so many workers hit what I call the retirement mirage. The retirement mirage says, if I just earn enough, I'll finally feel secure. But what actually happens, you hit 6 figures. Then taxes rise, rent rises, childcare rises, everything rises. And instead of feeling rich, you feel weirdly stuck because the finish line is fake. A high salary does not automatically produce wealth, especially when that salary is your whole identity, your whole plan, and your most heavily exposed tax stream. That's why people making $150K can still feel broke. Not because $150K is nothing. It's because gross income is a vanity number. What matters is what you keep, what you own, what compounds, what doesn't require your constant exhaustion. And there's a deeper psychological trap here. It's called status quo bias. You start believing that because your paycheck is familiar, it's safe. Then there's lifestyle inflation. Every raise becomes a nicer apartment, a nicer car, better restaurants, better vacations, a more expensive zip code. Then comes identity lock-in. You start seeing yourself as the job title. So the very thing that's taxing you, draining you, and trapping you becomes the thing you're afraid to question. That's the prison. Invisible, polite, socially respected, still a prison. Now let's kill the most recycled middle-class advice on the internet. Just budget harder. Look, budgeting matters, but budgeting is not a jailbreak plan. It's damage control. If you are in a 24% federal bracket on part of your income, plus 7.65% employee payroll tax, plus state tax in many places, you are not going to coupon your way into financial freedom. You are not going to meal prep your way around a structurally weak income design. You cannot out-frugal a bad tax structure. That doesn't mean be reckless. It means stop pretending microscopic savings habits can outperform macro-level structural leaks. And then there's the fake rich tax strategy everybody loves to cosplay. Buying liabilities for the deduction. The classic example, the $70,000 truck. Somebody says, "Bro, it's a write-off." No, it's usually an ego purchase wearing a tax costume. Let me translate. If you spend $70,000 to maybe save, $15,000 or $20,000 in taxes, depending on the situation, you are still down $50,000 plus, and now you own a depreciating metal box with insurance, maintenance, tires, and financing costs. That is not wealth building. That is net worth vandalism. And for pure W-2 employees, it gets even more ridiculous, because many of the sexy business deductions they hear about don't apply to employee expenses the way they imagine. So now they're copying entrepreneur tax talk without entrepreneur economics. That's how people stay broke while sounding sophisticated. A deduction does not make a bad purchase good. A liability does not become an asset because TikTok called it a write-off. If your solution to being overtaxed is buying more stuff, you didn't solve the problem, you deepened it. So what do? Quit your job tomorrow? No, that's usually emotional, not strategic. Here's the move. Use the 9-to-5 to fund the exit from the 9-to-5. That's the cheat code. Not escape work by Friday, not manifest abundance, not start a dropshipping empire in 48 hours. The real move is simple. Use your heavily taxed W-2 income to buy lightly taxed, compounding, ownership-based assets. That means building what I call your shadow portfolio. Your shadow portfolio is the financial life you build behind the paycheck, quietly, consistently, without needing permission. Index funds, real estate, a small business, a side business with actual profit, cash-flowing assets, equity positions. anything that moves you from labor-only income toward ownership income. The W-2 is not the destination. It is the fuel tank. That mindset changes everything. Now every paycheck has a mission. Not just bills, not just survival, not just lifestyle maintenance. Acquisition. You're buying back your future one asset at a time. And the beauty is you do not need to be dramatic. You can start small. Automatic index fund contributions, a side skill that becomes business income. House hacking, saving for your first rental, using bonuses to buy productive assets instead of status symbols. This is how normal people create wealth without burnout. Because the ultimate goal is not a giant salary. The ultimate goal is wealth without burnout, freedom without constant grind, income without constant panic, a life where taxes don't hit every single dollar at the worst possible angle because more and more of your money comes from assets, not just labor. That is the transition. From employee only to employee plus owner, then from employee plus owner to owner who can work if they want to. That is the real finish line. Not more prestige, not a fancier LinkedIn title, not a bigger car payment. Ownership, cash flow, optionality. So if this video hit you in the chest a little bit, good. That means you're waking up. Subscribe to the channel. Stop getting taxed into poverty. Stop confusing income with wealth, and start building your shadow portfolio now. Because the invisible prison only stays invisible until you finally learn to see the bars.